everyone, and welcome to the Q2 Global Market Outlook, Staying Safe. After a challenging 2022, the first quarter has seen some stability return to markets. Today we will discuss whether this is going to extend through the rest of the year. I'm delighted to have with me today Audrey, Abhilash and Herein to discuss the outlook. So Audrey, let's start with you. So the theme for Q2 is staying safe. Can you give us a sense of what that means for investors?
Well, we expect a high probability of a US recession over the next 12 months. More of our recession checklists have been triggered. So out of the 15 indicators that we monitor, only 4 have yet been triggered. For example, the yield curve, which is the spread between longer-term and shorter-term interest rates, that remains deeply inverted where the short-term yields are higher than the long-term ones. And this has been one of the most reliable indicators of a recession and has been signaling a recession since October last year. Against that backdrop, we remain defensively positioned. We believe that building a safe foundation, which we have been advocating since the start of the year, remains appropriate. And that includes 1, securing our yields as we approach a peak in central bank rate hiking cycle. So this means being overweight on income strategies as well as high quality investment grade bonds as we enter into a recession. 2, we would also allocate to areas where there are long-term value. And here we prefer Asian assets, Asian equities, as well as Asian US dollar bonds, which are yielding in excess of 6%. 3, we would also fortify our portfolio by considering some allocation to cash and gold. We also like developed market investment grade government bonds, as this asset class, together with gold, tend to do quite well during recessions. And then last but not least, we would continue to build a core allocation to alternative strategies. The experience over the past year have taught us the importance of diversification, particularly to less correlated asset classes outside of traditional stock and bond markets.
Okay, so you talk about US recession. China looks a little bit better. What's your thoughts there?
Well, in terms of China, that has been one of our preferred markets in 2023. Unlike the US and Europe, where we see elevated probability of a recession, we expect the Chinese economy to rebound very strongly as mobility picks up. Several measures we monitor, for example, road congestion, as well as metro passenger volume, they have all rebounded strongly and are now back to pre-pandemic levels. If we look at consumption, fixed asset investments, and even the distressed property sector, they are also showing increased signs of a recovery as economic activity gradually normalizes.
So Abhilash, looking for a recession in the US, how does that feed into your views on the bond market?
Thank you, Steve. So, in fact, if you look at it, the heightened risk of US recession as well as the attractive yield on offer are the 2 key drivers for our overweight stance on bonds. Now, if you focus on the yield aspect, as you can see on the chart here, most of the areas in the bond markets are offering fairly attractive yields when compared to the yields that were on offer at the end of 2021, but also relative to the range they have been in since 2010. Given our view of the recession, we believe that the Fed will need to cut rates towards the later part of the year, driving 10-year US government bond yields lower. And as we all know, lower bond yields mean higher bond prices. Now, in fact, we have revised our end 2023 expectation for 10-year US Treasury yields lower towards 2.75 to 3% range. As a result, the risk reward for developed market investment grade government bonds has improved in our opinion, and we have recently upgraded them to an overweight stance within a global bond portfolio. Staying with developed market bonds, we are underweight on developed market high yield corporate bonds despite the attractive yield they offer, because the credit spreads or yield premiums are broadly in line with historical averages and offer poor compensation for the potential increase in default rates that tends to happen when economic growth slows down.
Okay, so you've covered developed markets. What about outside developed markets in Asia, for instance?
Well, apart from developed markets, Asian US dollar bonds is the other area that we like, and that is driven by 3 key factors. So first of all, Chinese issuers are a big component of Asian US dollar bond index, accounting for nearly half of the total bonds in the space. Since the release of our 2023 outlook, we have seen a faster than expected reopening of China, and China's GDP growth forecasts are still being revised higher by the analysts on the street. The improved growth as well as prospects of better corporate earnings for Chinese issuers is clearly a positive for Asian dollar bonds. Secondly, the asset class now offers a yield premium of over 300 basis points, which is clearly attractive and offers good value in our opinion. In fact, they now offer a higher yield compared to local currency bonds for the first time since 2009 and 10. Last but not the least, 85% of bonds in Asian dollar bond index are investment grade rated, and we believe that this provides a strong shelter in terms of credit fundamentals to weather a US and Europe-led recession. Within Asia as well, we do have a preference for investment grade bonds over high yield bonds.
So Fukian, let's move on to the outlook for equity markets. I guess a recession in the US can be good for bond markets, but probably less so good for equity markets.
Yeah, indeed, we have an underweight view for global equities now. Historically, when there has been a US recession, the equity market has always bottomed only after the recession has started. And one reason for this is that recessions lead to a potentially sharp adjustment to corporate earnings. This chart here shows the peak to trough decline in US corporate earnings in the past 10 recessions. So the median decline is 11%, but you can see in the last 3 recessions have been seen a more severe drop, and therefore with the downside risk to earnings, we expect another leg lower in developed market equities before we have a bottom in place. And a key indicator for us that the outlook is improving would be when central banks start to focus on supporting the economy rather than worrying about inflation.
Well, we talked earlier about Asia being in a different stage of the economic cycle. Does that mean it's a slightly different view for Asian equities?
Yeah, over there, the picture is different. So Asia ex-Japan is our most preferred region in equities, and the main driving force is Chinese equities, which is more than 40% of the Asia ex-Japan market. We believe China's economic recovery will support better earnings growth, and a potential deceleration in Fed rate hikes and a weaker US dollar may also lead to fund inflows to the region. So this graph here shows that a US dollar weakness, it generally leads to outperformance of Asia ex-Japan equities, i.e. both lines on this chart going up. Within the region, we are overweight on China. The National People's Congress in March stressed upon high quality growth and economic stability. And with China's reopening, we believe investors' sentiment and consumer spending will continue to improve, boosting earnings growth there. The valuation in China also remains attractive, trading at a 19% discount in PE to Asia ex-Japan equities, which is below its long-term average discount of 8%.
Okay, finally, let's talk about sectors. Obviously the recession in the US, growth in China. So how are you balancing that out from a sector perspective?
Yeah, so this graphic here summarizes our sector preferences in the US, Europe, and China. In the US, given our view that recession is likely, we want to position defensively through the consumer staples, healthcare, and utilities sector. These sectors have historically delivered resilient earnings growth even in a recession, and so we believe they can outperform the broader market. For China, where the economy is at a very different stage, heading into a cyclical upturn, we like communication services, consumer discretionary, technology, and industrials. So communication and discretionary will benefit from greater consumer spending in China, while technology and industrials have attractive valuations and also policy support from the government in our view.
Okay, Abhis, let's come back to you and talk about currencies, right? So a lot of people would say, okay, we have the dollar smile, so in risk-off situations, which associated with the recessions, you get dollar strength. So, we're expecting a recession. Does that mean we're going to see dollar strength coming through?
That's an interesting point, and certainly there are a lot of people out there who believe that US dollar should strengthen during a recession or other events that lead to a risk-off environment in the markets. But if we actually look at the historical data, the track record for the dollar is quite mixed. On our end, we believe that US's eroding yield advantage is going to be the dominant factor. So we expect 2-year and 10-year US government bond yields to decline over the next 6 to 12 months, eroding US dollar's interest rate advantage. Additionally, if we go back to the US dollar smile framework, we think that it argues for a weaker dollar as well. So imagine a smile where the dollar does well on two extreme sides when markets are in extreme stress or US growth is really well. But if we think about the middle part where global growth is broadly in line with US growth or slightly outperforming it, that's an environment where US dollar tends to weaken. And lastly, despite the nearly 10% decline since October 2022 highs, the dollar still screens as expensive relative to its fundamentals in our opinion. The key risk here, of course, is that US inflation proves to be a lot more persistent, or US growth slows down much more sharply than expected, pushing dollar to one of those extremes of the smile.
Okay, so which currencies do you expect to benefit the most from dollar weakness?
Based on our 12-month forecast, there are three pairs that look interesting to me: the euro, the Japanese yen, as well as gold. So let's start with the euro. So euro is one of those classic anti-dollar currencies, and we expect the euro to be one of the main beneficiaries of weaker dollar in the next 3 to 12 months. If you think about the still elevated inflation in Europe, we think ECB should hike rates by another 50 basis points and keep the rates at 3.5% till end of 2023, giving it an edge over the US dollar. Additionally, lower energy import costs could cause current account surplus over the next 12 to 18 months, which along with improved portfolio flows and economic sentiment should result in favorable technicals for the euro. Another beneficiary of dollar weakness is Japanese yen. So we expect dollar yen to push towards 120, 125 range as we expect decline in US Treasury yields to lead to more favorable interest rate differentials. Last but not the least, we also raise gold to an overweight stance. While near-term bullish positioning could be a headwind for gold prices, we expect gold to benefit from both falling bond yields as well as its track record of usually delivering positive returns during economic recessions. In fact, with the exception of 1981, gold has delivered positive returns in 10 out of last 11 recessions, and it arguably retains its safe haven properties during time of crisis.
Okay, Audrey, can you bring this all together? How should investors be positioned given the outlook we've presented today?
We believe the core approach of our SAFE strategy remains intact. Our increased expectation of a US recession this year lead us to prefer quality bonds and income strategies, which see as an attractive and diversified way to navigate a slowing global growth outlook. We would also allocate to Asian assets where we see value, and given heightened recession risk, we would also fortify our portfolio against potential negative surprises, and that will be through developed market, investment-grade government bonds, cash, as well as gold. And then last but not least, investors can also consider an allocation to alternative assets. These are less correlated to traditional stocks as well as bond markets.
Okay, that's all we have time for today. Thank you for joining us, and thank you, Abhilash, Audrey and Fukien for giving your insights. If you'd like to stay updated as to our latest views, please go to Standard Chartered Wealth Insights on LinkedIn and Facebook. And with that, I wish you a very pleasant day.